Question 1. Which of the following is the primary advantage of a variable annuity compared to a fixed annuity? A. Guaranteed minimum interest rate. B. Greater potential for investment growth. C. Predictable periodic payments. D. Tax-deferred growth on premiums. Answer: B. Greater potential for investment growth. Explanation: a variable annuity offers the potential for greater investment growth compared to a fixed annuity because it allows the policyholder to invest in sub-accounts, typically mutual funds or similar investment vehicles. This gives the policyholder exposure to market returns, which can result in higher growth. However, the trade-off is that the investment performance is subject to market risk, meaning the value of the annuity can fluctuate. Option A refers to a fixed annuity's guaranteed interest rate, not a feature of variable annuities. Option C is more aligned with fixed annuities, which offer predictable payments. Option D is true for both types, but it does not specifically explain the advantage of variable annuities over fixed ones. Question 2. Mr. Thompson is a 65-year-old retiree who wishes to purchase an annuity for predictable income for life. He is concerned about outliving his savings and is looking for a product that will provide stable payments regardless of market performance. Which type of annuity would best meet his needs? A. Fixed annuity. B. Variable annuity with a guaranteed minimum income benefit. C. Indexed annuity. D. Immediate annuity with a life option. Answer: D. Immediate annuity with a life option. Explanation: an immediate annuity with a life option, also called a life-only option, provides predictable, guaranteed income for the annuitant's lifetime, which aligns with Mr. Thompson's concern about outliving his savings. This type of annuity begins payments immediately and ensures the annuitant receives payments for as long as they live, providing financial security. The income amount is fixed and does not depend on market performance. Option A is a fixed annuity which provides predictable payments but does not begin immediately unless it's a specific immediate version of a fixed annuity. Option B is a variable annuity which involves investment risk and may not be suitable for Mr. Thompson's need for stability. Option C is an indexed annuity which links returns to a stock index but still carries some market risk. Question 3. Which of the following statements about annuity taxation is true? A. The premiums paid for a non-qualified annuity are tax-deductible. B. The interest earned on a non-qualified annuity is taxed as ordinary income when withdrawn. C. The withdrawal of principal from a qualified annuity is subject to tax penalties. D. The death benefit from a non-qualified annuity is not taxable to the beneficiary. Answer: B. The interest earned on a non-qualified annuity is taxed as ordinary income when withdrawn. Explanation: in non-qualified annuities, the principal, the amount invested, is not subject to taxation upon withdrawal, but the earnings interest are taxed as ordinary income. This means that when a policyholder withdraws funds, they must pay taxes on the earnings portion of the withdrawal. Option A is incorrect because premiums paid for non-qualified annuities are not tax-deductible. Option C is incorrect because the withdrawal of principal from a qualified annuity, which is funded with pre-tax dollars, is not subject to penalties. Only the earnings are taxable and penalties apply to early withdrawals of earnings. Option D is incorrect because the death benefit of a non-qualified annuity is generally taxable to the beneficiary depending on the situation and whether the beneficiary is receiving the death benefit as a lump sum or in other forms. Question 4. Which of the following is a key difference between a fixed annuity and a variable annuity? A. A fixed annuity provides a return based on the performance of market indices, while a variable annuity does not. B. A fixed annuity has a guaranteed minimum interest rate, while a variable annuity's return is based on market performance. C. A fixed annuity offers no tax-deferred growth, while a variable annuity does. D. A fixed annuity allows the policyholder to choose from multiple sub-accounts for investment, while a variable annuity does not. Answer: B. A fixed annuity has a guaranteed minimum interest rate, while a variable annuity's return is based on market performance. Explanation: Option B is correct because fixed annuities offer a guaranteed minimum interest rate and provide predictable payments regardless of market performance. In contrast, variable annuities have returns that are tied to the performance of underlying investments, which can vary based on market conditions. Option A is incorrect because fixed annuities do not involve market performance in the same way variable annuities do. Option C is incorrect because both fixed and variable annuities offer tax-deferred growth. Option D is incorrect because only variable annuities allow the policyholder to select from multiple sub-accounts. Question 5. Mr. Miller is considering purchasing an indexed annuity with a cap rate of 5% and a participation rate of 80%. If the index return for the year is 7%, what will be the return credited to Mr. Miller's annuity? A. 5%, B. 6%, C. 7%, D. 4%. Answer: A 5%. Explanation: an indexed annuity ties its return to a market index, but the return is subject to two factors: the cap rate and the participation rate. In this case, the cap rate is 5%, meaning that even if the index return is higher, the maximum return Mr. Miller can earn is 5%. Therefore, the return credited to his annuity will be a cap rate of 5% despite the index return being 7%. Option B is incorrect because the participation rate does not come into play since the cap rate limits the return. Option C is incorrect because the index return exceeds the cap rate. Option D is incorrect because the return will not be less than the cap rate. Question 6. Which of the following riders provides a guarantee that the annuitant can withdraw a set percentage of the contract value each year for their lifetime regardless of market performance? A. Guaranteed Minimum Income Benefit (GMIB). B. Guaranteed Minimum Withdrawal Benefit. C. A Guaranteed Minimum Accumulation Benefit (GMAP). D. Long-Term Care Rider. Answer: B. Guaranteed Minimum Withdrawal Benefit. Explanation: Option B is correct because the Guaranteed Minimum Withdrawal Benefit rider guarantees that the annuitant can withdraw a set percentage of the contract value each year for their lifetime regardless of how the underlying investments perform. Option A is incorrect because the GMIB provides a minimum income guarantee based on the annuitant's lifetime, but it does not guarantee withdrawals based on a percentage of the contract value. Option C is incorrect because the GMAB rider guarantees a minimum accumulation value, but it does not provide guaranteed withdrawals. Option D is incorrect because a long-term care rider typically provides benefits in the event of the annuitant needing long-term care, not a guaranteed withdrawal. Question 7. Which of the following is an example of a suitability requirement when recommending an annuity to a client? A. Recommending an annuity that matches the client's time horizon and retirement goals. B. Recommending the highest commission product to maximize income. C. Recommending a product based solely on the client's age. D. Recommending an annuity that has the lowest surrender charge. Answer: A. Recommending an annuity that matches the client's time horizon and retirement goals. Explanation: Option A is correct because suitability regulations require that the annuity recommended to a client aligns with their time horizon, retirement goals, risk tolerance, and financial situation. This ensures that the client's needs are met with the most appropriate product. Option B is incorrect because suitability is not based on maximizing commissions, but on the client's needs. Option C is incorrect because age alone does not determine the suitability of an annuity. Other factors such as financial goals and risk tolerance must also be considered. Option D is incorrect because while surrender charges are a factor, suitability is focused on the client's overall needs, not just the cost of the product. Question 8. Mr. Garcia purchased a non-qualified annuity and is considering withdrawing $20,000 from his account. The annuity has $50,000 of premium payments and $15,000 of earnings. What amount of taxes will Mr. Garcia likely owe on the withdrawal if the $20,000 is considered? A partial withdrawal: A. $0. B. $4,000. C. $5,000. D. $8,000. Answer: B. $4,000. Explanation: when withdrawing from a non-qualified annuity, the earnings are taxed as ordinary income. For partial withdrawals, the IRS treats the withdrawal as a prorated portion of both principal and earnings. Since Mr. Garcia's account has $15,000 in earnings and $50,000 in premiums, the percentage of earnings in the account is 15,000 50,000 plus 15 equals 15,000 65 equals 23.8%. Therefore, 23.8% of the $20,000 withdrawal is considered earnings. 20,000 x 0.2308 equals 4,616. Thus, $4,000 of the withdrawal is subject to taxes, rounded. This amount will be taxed at Mr. Garcia's ordinary income tax rate. Option A is incorrect because the withdrawal includes earnings, which are taxable. Option C is incorrect because it overestimates the tax due on the withdrawal. Option D is incorrect because it assumes a higher tax rate. Question 9. Which of the following is a characteristic of a qualified annuity? A. Contributions to the annuity are made with after-tax dollars, and the annuity grows tax-deferred. B. Contributions to the annuity are made with pre-tax dollars, and withdrawals are subject to ordinary income tax. C. Qualified annuities do not have required minimum distribution RMDS. D. The earnings on a qualified annuity are not taxed upon withdrawal. Answer B. Contributions to the annuity are made with pre-tax dollars and withdrawals are subject to ordinary income tax. Explanation. Option B is correct because qualified annuities are funded with pre-tax dollars, i.e. contributions are tax deferred, and when withdrawals are made, the earnings are taxed as ordinary income. Option A is incorrect because while tax deferred growth is a characteristic of qualified annuities, they are funded with pre-tax dollars, not after-tax dollars. Option C is incorrect because qualified annuities do have required minimum distribution RMDS starting at age 73. Option D is incorrect because the earnings on a qualified annuity are subject to ordinary income tax upon withdrawal. Question 10. Which of the following best describes the free look period for an annuity? A. The period during which the annuitant can withdraw funds without incurring a surrender charge. B. The period during which the annuitant can cancel the annuity contract for a full refund of the premium. C. The time frame when the annuity begins making payments to the annuitant. D. The period during which the insurance company can change the terms of the annuity. Answer B. The period during which the annuitant can cancel the annuity contract for a full refund of the premium. Explanation. Option B is correct because the free look period allows the annuitant a set period of time, usually 1030 days, to review the annuity contract. If they decide it's not suitable, they can cancel the contract and receive a full refund of the premium. Option A is incorrect because the free look period is not for withdrawals without charges, but for cancelling the contract for a refund. Option C is incorrect because the annuity payments start when the annuitant begins the annuitization phase, not during the free look period. Option D is incorrect because the free look period does not allow the insurance company to change the terms. Question 11. A variable annuity has a death benefit that guarantees the beneficiary will receive at least the amount of premiums paid into the contract regardless of the annuity's market performance. This is called A minimum death benefit rider, B guaranteed minimum death benefit GRB, C living benefit rider, D surrender benefit rider. Answer B guaranteed minimum death benefit GRE. Explanation. Option B is correct because the GMDB ensures that the beneficiary receives a guaranteed minimum amount upon the death of the annuitant, regardless of how the annuity's underlying investments perform. Option A is incorrect because a minimum death benefit rider might not necessarily guarantee a return of premiums. Option C is incorrect because living benefit riders pertain to benefits while the annuitant is alive, not after death. Option D is incorrect because a surrender benefit rider refers to the amount the annuitant would receive if they surrendered the annuity, not related to death benefits. Question 12. What is the primary purpose of the annuitization phase of an annuity contract? A. To increase the value of the annuity by reinvesting interest. B. To convert the accumulated value into a stream of income payments. C. To allow the annuitant to make additional premium contributions. D. To surrender the contract and receive the full accumulation value. Answer. B. To convert the accumulated value into a stream of income payments. Explanation. Option B is correct because the annuitization phase converts the accumulated value of the annuity into periodic income payments to the annuitant. Option A is incorrect because during the annuitization phase, the focus is on converting accumulated value into income, not reinvesting interest. Option C is incorrect because after the annuitization phase, no more premiums are paid and the annuitant starts receiving payments. Option D is incorrect because the annuitization phase is not about surrendering the contract, it's about starting income payments. Question 13. Which of the following would typically not be a reason to recommend an annuity to a client? A. The client wants guaranteed lifetime income. B. The client has a high-risk tolerance and seeks aggressive growth. C. The client is seeking tax-deferred growth. D. The client wishes to protect against outliving their assets. Answer B. The client has a high-risk tolerance and seeks aggressive growth. Explanation. Option B is correct because annuities, especially fixed and fixed-indexed annuities, are more appropriate for clients seeking stable, guaranteed income rather than those with a high-risk tolerance looking for aggressive growth. Option A is incorrect because annuities are often used to provide guaranteed lifetime income. Option C is incorrect because annuities offer tax-deferred growth. Option D is incorrect because one of the primary benefits of annuities is protecting against the risk of outliving assets. Question 14. Which of the following is a characteristic of a fixed annuity? A. Returns are based on the performance of the stock market. B. Payments are guaranteed to increase over time. C. The insurer guarantees a minimum interest rate. D. Payments fluctuate based on the performance of the annuity's subaccounts. Answer: C. The insurer guarantees a minimum interest rate. Explanation: Option C is correct because fixed annuities guarantee a minimum interest rate and provide a stable, predictable return for the annuitant. Option A is incorrect because returns in a fixed annuity are not tied to the stock market performance. Option B is incorrect because fixed annuities generally do not have increasing payments unless a specific rider is purchased. Option D is incorrect because payments in a fixed annuity do not fluctuate based on subaccount performance. This is characteristic of variable annuities. Question 15. What is the primary risk associated with variable annuities? A. Inflation risk. B. Longevity risk. C. Market risk. D. Credit risk. Answer: C. Market risk. Explanation: Option C is correct because variable annuities are tied to the performance of underlying investments, meaning the annuitant faces market risk that their returns may decrease based on market conditions. Option A is incorrect because inflation risk is a concern for all types of annuities, but is not the primary risk of variable annuities. Option B is incorrect because longevity risk is the risk of outliving income, which can affect all types of annuities. Option D is incorrect because credit risk is the risk that the insurance company defaults, which is a concern for any insurance product but not specific to variable annuities. Question 16. Which of the following is NOT typically a feature of an immediate annuity? A. Payments begin shortly after the annuity is purchased. B. The annuitant can choose to receive payments for a fixed period or for life. C. The annuitant makes lump sum premium payments. D. The annuity has a long accumulation phase before payments begin. Answer: D. The annuity has a long accumulation phase before payments begin. Explanation: Option D is correct because immediate annuities do not have a long accumulation phase. Payments typically begin immediately or shortly after purchase. Option A is incorrect because immediate annuities are designed to begin payments soon after purchase. Option B is incorrect because an immediate annuity allows the annuitant to choose whether to receive payments for a fixed period or for life. Option C is incorrect because the annuitant makes a lump sum payment upfront for immediate annuities. Question 17. Which of the following statements about annuities is true? A. Annuities always have a fixed interest rate. B. Annuities offer guaranteed income for a lifetime or a set period. C. Annuities require the policyholder to make annual premium payments for the life of the contract. D. Annuities always have surrender charges if funds are withdrawn early. Answer: B. Annuities offer guaranteed income for a lifetime or a set period. Explanation: Option B is correct because one of the main features of annuities is the ability to provide guaranteed income for the annuitant, either for their lifetime or for a set period, depending on the terms of the contract. Option A is incorrect because not all annuities have a fixed interest rate. Variable and indexed annuities are subject to market performance. Option C is incorrect because annuities do not always require annual premium payments after the initial purchase. They may have a single lump sum payment. Option D is incorrect because not all annuities have surrender charges, while others have flexible withdrawal options. Question 18. What is a rider in the context of an annuity contract? A. A contract provision that reduces the annuitant's premium payments. B. A separate contract that is sold alongside the annuity. C. An additional benefit or feature added to the annuity contract, usually for an extra cost. D. A clause that allows for early withdrawal without penalty. Answer: C. An additional benefit or feature added to the annuity contract, usually for an extra cost. Explanation: Option C is correct because a rider is an optional provision that can be added to an annuity contract to provide additional benefits such as guaranteed income, long-term care benefits, or death benefits. Riders typically come at an additional cost and are designed to tailor the annuity to the specific needs of the annuitant. Option A is incorrect because a rider does not reduce the annuitant's premium payments. Instead, it typically adds extra benefits for an additional cost. Option B is incorrect because a rider is not a separate contract but an add-on feature attached to the existing annuity contract. Option D is incorrect because while some annuities may have provisions for early withdrawals, this is generally not referred to as a rider. Riders usually add extra features related to benefits like income guarantees or death benefits. Question 19. Which of the following is a potential disadvantage of an annuity with a long surrender period? A. The annuitant can face penalties for withdrawals within the surrender period. B. The annuitant cannot access their funds during the surrender period. C. The insurance company can alter the terms of the contract during the surrender period. D. The annuitant must continue making premium payments during the surrender period. Answer A. The annuitant can face penalties for withdrawals within the surrender period. Explanation. Option A is correct because annuities with a surrender period, typically 5 years, impose penalties or surrender charges if the annuitant withdraws funds during that time. These charges are designed to protect the insurer from early withdrawals. Option B is incorrect because while there may be penalties, the annuitant can still access their funds. They just may face penalties. Option C is incorrect because the terms of the contract generally remain fixed once the annuity is issued, and the insurer cannot alter the terms during the surrender period. Option D is incorrect because once the annuity is purchased, the annuitant typically doesn't need to make additional premium payments unless specified, e.g., in flexible premium annuities. Question 20. Which of the following is a key feature of a deferred annuity? A. Payments are made immediately after purchase. B. Payments are made after a specified accumulation period. C. The annuitant receives a lump sum payment instead of periodic income. D. The annuity is designed to last for a fixed number of years. Answer. B. Payments are made after specified accumulation period. Explanation. Option B is correct because deferred annuities accumulate funds over a period of time, the accumulation phase, before the annuitant begins to receive income payments which occur later in life. Option A is incorrect because immediate annuities begin payments right after purchase, not deferred annuities. Option C is incorrect because annuities typically provide periodic income, not a lump sum. Option D is incorrect because while deferred annuities can be structured for various periods, the defining feature is the delay in starting income payments, not a set duration. Question 21. Which of the following is a characteristic of a fixed indexed annuity? A. The annuitant's returns are based solely on stock market performance. B. The annuitant's returns are guaranteed to be fixed. C. The annuitant's returns are linked to a stock market index but with a cap on gains. D. The annuity provides no guarantees on returns. Answer. C. The annuitant's returns are linked to a stock market index but with a cap on gains. Explanation. Option C is correct because fixed indexed annuities link returns to a stock market index such as the S&P 500 but impose a cap on how much the annuitant can earn, offering the potential for higher returns than a fixed annuity while providing downside protection. Option A is incorrect because although the annuity's performance is linked to an index, it does not directly track the stock market's performance and includes a cap on gains. Option B is incorrect because fixed indexed annuities do not offer fixed returns, but rather returns based on market performance with limitations. Option D is incorrect because fixed indexed annuities do offer guarantees such as protection from market losses and a minimum return. Question 22. Which of the following is an advantage of annuities over other investment vehicles? A. Annuities offer liquidity for investors who may need quick access to their funds. B. Annuities guarantee the principal amount invested will always increase. C. Annuities offer tax-deferred growth of earnings until withdrawal. D. Annuities provide a guaranteed return of principal if the annuitant dies before the contract matures. Answer. C. Annuities offer tax-deferred growth of earnings until withdrawal. Explanation. Option C is correct because annuities provide tax-deferred growth on the investment earnings, meaning the annuitant does not pay taxes on the earnings until they begin receiving income or make withdrawals. Option A is incorrect because annuities typically do not offer high liquidity. Withdrawals often come with penalties during the surrender period. Option B is incorrect because while annuities provide principal protection, especially in fixed annuities, they do not guarantee that the principal will always increase. Option D is incorrect because while many annuities provide death benefits, the return of principal is not always guaranteed and may depend on the specific terms of the contract. Question 23. Which of the following best describes a longevity rider on an annuity? A. A rider that guarantees the annuitant's payments will increase each year to keep pace with inflation. B. A rider that provides additional income if the annuitant lives longer than expected. C. A rider that allows for tax-free withdrawals from the annuity contract. D. A rider that provides a lump sum payout to beneficiaries if the annuitant dies. Answer. B. A rider that provides additional income if the annuitant lives longer than expected. Explanation. Option B is correct because a longevity rider offers additional income to the annuitant if they live longer than their life expectancy, ensuring they do not run out of funds in old age. Option A is incorrect because inflation riders adjust payments for inflation, not longevity. Option C is incorrect because annuities do not typically offer tax-free withdrawals. Taxation depends on the type of annuity and the timing of withdrawals. Option D is incorrect because the rider providing a death benefit to beneficiaries is a death benefit rider, not a longevity rider. Question 24. What is a key difference between a traditional fixed annuity and a variable annuity? A. Fixed annuities provide returns based on a stock market index, while variable annuities offer a guaranteed interest rate. B. Variable annuities offer the potential for high returns, but with more risk than fixed annuities. C. Fixed annuities do not require premium payments, while variable annuities require ongoing premium payments. D. Variable annuities guarantee a fixed income for life, while fixed annuities offer no such guarantee. Answer B. Variable annuities offer the potential for higher returns, but with more risk than fixed annuities. Explanation. Option B is correct because variable annuities allow the annuitant to allocate their premiums among a variety of investment options, such as mutual funds, which can result in higher returns. However, the returns are subject to market risk. Fixed annuities, on the other hand, offer a guaranteed return with less risk but also less potential for high returns. Option A is incorrect because neither annuity type automatically offers returns based on a stock market index. While variable annuities involve investment in the market, fixed annuities offer a guaranteed interest rate. Option C is incorrect because both fixed and variable annuities generally require ongoing premium payments unless purchased as single premium annuities. Option D is incorrect because both types of annuities can offer income for life depending on the specific contract terms, not necessarily fixed annuities alone. Question 25. Which of the following statements about a death benefit in an annuity is correct? A. The death benefit is paid out only if the annuitant dies during the accumulation phase. B. The death benefit is equal to the annuity's value at the time of the annuitant's death. C. The death benefit is always paid out as a lump sum. D. The death benefit is available only with variable annuities. Answer B. The death benefit is equal to the annuity's value at the time of the annuitant's death. Explanation. Option B is correct because the death benefit generally represents the value of the annuity at the time of the annuitant's death. This could be the accumulated value or a minimum amount, depending on the contract terms. Option A is incorrect because death benefits can apply at any time, not just during the accumulation phase. Option C is incorrect because the death benefit can be paid as a lump sum or as other payment options, depending on the contract. Option D is incorrect because both fixed and variable annuities can include a death benefit provision. Question 26. Which of the following best describes a joint and survivor annuity? A. An annuity that provides income only to the annuitant with no payments after their death. B. An annuity that guarantees income for two lives, typically a married couple with payments continuing after one spouse's death. C. An annuity that provides payments for a set period of time and after which no further payments are made. D. An annuity that pays a lump sum to beneficiaries upon the annuitant's death. Answer B. An annuity that guarantees income for two lives, typically a married couple with payments continuing after one spouse's death. Explanation. Option B is correct because the joint and survivor annuity provides income for two lives, usually a married couple. After one spouse dies, the surviving spouse continues to receive payments either at the same level or a reduced level, depending on the terms of the contract. Option A is incorrect because this describes a single life annuity, not a joint and survivor annuity. Option C is incorrect because this describes an installment certain annuity, which guarantees payments for a specified period, not for two lives. Option D is incorrect because it refers to a lump sum death benefit, not a joint and survivor annuity. Question 27. What is a key disadvantage of purchasing an annuity with a long surrender period? A. The annuitant may not have access to their funds without incurring penalties for an extended time. B. The annuity payments may be lower than expected. C. The annuitant must make additional premium payments throughout the surrender period. D. The annuity's value will be automatically adjusted to reflect changes in market interest rates. Answer A. The annuitant may not have access to their funds without incurring penalties for an extended time. Explanation. Option A is correct because long surrender periods typically come with surrender charges if the annuitant withdraws funds early. This means that the annuitant may face penalties for accessing their funds during this period. Option B is incorrect because the payment amount is not directly impacted by the surrender period, although other factors, e.g., investment performance, annuity type, affect the amount. Option C is incorrect because ongoing premium payments are not required for all annuities, especially if it's a single premium annuity. Option D is incorrect because annuities do not automatically adjust to market interest rates, so they may be fixed or variable depending on the product. Question 20. What is the purpose of a spendthrift provision in an annuity contract? A. It guarantees that the annuitant will not outlive their income. B. It prevents creditors from accessing the annuitant's income or benefits. C. It allows the annuitant to withdraw a lump sum from the annuity without penalty. D. It ensures that the annuitant will receive income for a set period of time. Answer B. It prevents creditors from accessing the annuitant's income or benefits. Explanation. Option B is correct because a spendthrift provision in an annuity protects the annuitant's income from creditors, meaning that even if the annuitant faces financial difficulties or lawsuits, their annuity payments are shielded. Option A is incorrect because the spendthrift provision does not guarantee lifetime income. It focuses on creditor protection. Option C is incorrect because a spendthrift provision does not affect the withdrawal terms of the annuity. Penalties for early withdrawal are governed by the annuity contract itself. Option D is incorrect because the spendthrift provision does not affect the duration of income payments. Question 29. Which of the following is typically not a benefit of a deferred annuity? A. Tax-deferred growth of earnings. B. Lifetime income guarantees. C. Immediate access to funds during the accumulation phase. D. Protection against market losses for some types. Answer. C. Immediate access to funds during the accumulation phase. Explanation. Option C is correct because deferred annuities have an accumulation phase where funds are growing and access to those funds is typically limited during this phase. Withdrawals before the contract's maturity may be subject to penalties. Option A is incorrect because tax-deferred growth is one of the key benefits of a deferred annuity. Option B is incorrect because lifetime income guarantees are common in many deferred annuity contracts, particularly in fixed and variable options with income riders. Option D is incorrect because some deferred annuities, particularly fixed-indexed annuities, offer protection against market losses, although the returns may still be subject to limits like caps or participation rates. Question 30. Which of the following would likely make a variable annuity less suitable for an investor with a low risk tolerance? A. The annuity guarantees a fixed income for life. B. The annuity's performance is tied to a stock market index. C. The annuity provides no tax deferral. D. The annuity allows for tax-free withdrawals. Answer. B. The annuity's performance is tied to a stock market index. Explanation. Option B is correct because a variable annuity's performance is tied to market investments such as stocks or mutual funds. This can lead to higher returns, but also increases the risk of loss, which may make it unsuitable for those with low risk tolerance. Option A is incorrect because a fixed income guarantee would make the annuity more suitable for someone with low risk tolerance. Option C is incorrect because variable annuities do offer tax deferral on earnings. Option D is incorrect because tax-free withdrawals are not a typical feature of variable annuities.